Have you ever felt that nagging frustration when inflation headlines cool, yet your rent or mortgage payment keeps climbing? It's a common, perplexing disconnect that leaves many feeling financially squeezed and confused. This isn't just a feeling. It's a fundamental truth about how housing markets operate, often independently of broader economic trends. Housing is undeniably one of the most significant financial commitments for individuals and families alike. When economic reports suggest inflation is easing, a natural expectation arises. Shouldn't housing costs follow suit? This logical assumption, however, frequently clashes with the lived reality of renters, homeowners, students, and investors. The truth is, housing often marches to the beat of a different drum, one that's less about general price changes and more about deeply rooted market dynamics. This divergence can be incredibly frustrating, especially when budgeting for essential needs. We're here to unravel this complex issue, providing clarity where there's often only confusion. By the end of our discussion, you'll gain a comprehensive understanding of why housing costs exhibit such unique behavior. We'll explore why they tend to rise slowly but rarely fall, and why traditional inflation metrics often fail to capture the true financial pressure experienced by most people. This insight is crucial for anyone navigating today's housing landscape. This knowledge isn't just academic, it's a vital tool for personal finance planning and market analysis. Whether you're a student budgeting for your first apartment, a homeowner managing mortgage payments, a renter facing renewal, or an investor assessing market risks, understanding these dynamics is paramount. It empowers you to make more informed decisions. Let's begin with a foundational concept that underpins everything. Housing prices are primarily shaped by the immutable laws of supply and demand within a highly localized and often constrained market. Unlike many consumer goods, housing cannot be manufactured or transported quickly to meet sudden surges in demand. This inherent inelasticity is key. When demand for housing outstrips the available supply, prices inevitably rise. This isn't merely about general inflation, it's about a fundamental imbalance. Once these prices increase, they tend to establish a new baseline, rarely retreating significantly even if broader economic inflation moderates. This structural rigidity is a critical differentiator. Consider the stark contrast between housing and other goods. If the price of a specific food item rises, consumers might switch to an alternative or reduce consumption. If gas prices spike, people might drive less or seek public transport. Housing, however, offers very few immediate substitutes, making its demand relatively inelastic. This means that even when the overall economy experiences a period of disinflation, the underlying pressures in the housing market persist. The time it takes to build new homes, the regulatory hurdles, and the sheer capital investment required mean that supply cannot quickly adjust to demand shifts. This creates a persistent upward bias in costs. Imagine a scenario where the national inflation rate, after a period of rapid ascent, begins to stabilize. You might notice grocery bills becoming more predictable and perhaps even some relief at the gas pump. Yet, when your lease renewal arrives or your property tax assessment lands, the numbers continue their upward trajectory. This is not an anomaly. This divergence occurs because landlords and property owners don't set prices based on national inflation statistics. Their decisions are driven by local market conditions, the intense competition for limited units, the rising costs of property maintenance, insurance, and property taxes, and the prevailing demand in their specific area. These microeconomic factors often outweigh macroeconomic trends. From a renter's perspective, this means that even if their purchasing power for other goods improves, the relentless pressure on their largest monthly expense remains. For homeowners, rising property taxes and insurance premiums can erode any gains from slowing inflation elsewhere. This creates a significant personal finance challenge, impacting budgets and savings goals. Housing is not merely a commodity. It is a fundamental human need and a cornerstone of personal stability. This non-optional nature is precisely why rising housing costs feel so intensely stressful and financially burdensome. You cannot simply opt out of housing in the way you might choose to forego a discretionary purchase. The practicalities of moving further compound this stress. Relocation is expensive, time-consuming, and disruptive, often involving security deposits, moving costs, and the emotional toll of uprooting. Furthermore, the availability of affordable alternatives is often severely limited, leading to intense competition and a feeling of being trapped. This emotional weight is completely understandable and deeply impactful on personal well-being and financial planning. For students, it can mean taking on more debt or working longer hours. For families, it can mean sacrificing other essential needs or delaying major life milestones. Investors, too, face the emotional pressure of market volatility and policy changes. Beyond immediate supply and demand, several deep-seated structural factors contribute to housing's unique behavior. These elements create a persistent upward pressure on costs, making housing markets inherently slow to respond to broader economic shifts, especially on the downside. Understanding these constraints is vital for any market analysis. Construction, for instance, is a notoriously slow process. From securing permits to laying foundations and completing finishes, building new homes takes months, if not years. This inherent delay means that even if developers respond to increased demand today, the new supply won't hit the market for a considerable period, perpetuating shortages. Zoning regulations and land use policies also play a critical role. Many urban and suburban areas have restrictive zoning laws that limit density, dictate minimum lot sizes, or prohibit multifamily dwellings. While often intended to preserve neighborhood character, these policies inadvertently constrain housing supply, driving up the cost of available land and, consequently, housing. Financing costs, particularly interest rates, are another significant structural factor. When interest rates rise, the cost of borrowing for both developers and homebuyers increases. This can slow down new construction projects and make mortgages less affordable, further dampening demand for new homes while increasing the cost of ownership for existing ones. These structural impediments mean that even when inflation cools, the underlying shortage of housing, exacerbated by these long-term factors, does not magically disappear. This explains why housing costs respond slowly on the way up, as new supply struggles to keep pace, and even more slowly on the way down, as existing supply remains constrained and expensive to maintain. Government policies at local, state, and federal levels profoundly influence housing costs and availability. Understanding these policy discussions is crucial for anyone trying to grasp the full picture of the housing market. From tax incentives to infrastructure spending, policy decisions have long-lasting effects. For example, property tax policies directly impact homeowners' monthly expenses and landlords' operational costs, which are then passed on to renters. Rent control measures, while intended to protect tenants, can sometimes disincentivize new construction or proper maintenance, potentially exacerbating supply issues in the long run. Investment in public transportation and infrastructure can open up new areas for development, but the pace of such projects is often slow. Conversely, a lack of investment can concentrate demand in already expensive areas. These policy choices are complex, with various stakeholders advocating for different approaches, often leading to slow or incremental change. Once you internalize these distinct dynamics, the apparent disconnect between general inflation data and your personal housing costs becomes much clearer. Inflation slowing doesn't automatically translate into housing becoming more affordable or readily available. Instead, it often signifies an easing of price pressures in other sectors, while housing continues to follow its own unique trajectory. This analytical understanding, while not immediately reducing your financial burden, provides invaluable clarity. It helps explain why housing often feels like it exists in a category of its own, impervious to broader economic trends. This insight is empowering, allowing you to anticipate market movements and plan your personal finances more effectively. For investors, this reframe highlights the importance of understanding local market fundamentals, regulatory environments, and long-term demographic shifts, rather than relying solely on national economic indicators. For students, it underscores the need for robust financial planning and advocacy for policy changes that address affordability. Housing is one of the clearest and most impactful examples of how macroeconomic data and individual lived experience can diverge dramatically. On this channel, Our mission is to bridge that gap, explaining these complex financial realities calmly, clearly, and empathetically. We aim to equip you with the knowledge to navigate these challenges. In future discussions, we will continue to break down everyday expenses and financial concepts with the same analytical rigor and educational focus. We believe that understanding these underlying mechanisms is the first step toward making more informed personal finance decisions and advocating for meaningful policy changes. If there's a specific housing-related question, a particular cost component you'd like us to explore, or a policy discussion you believe is critical, please share your thoughts in the comments below. Your insights help shape our content and ensure we address the most pressing concerns of our community. Thank you for investing your time with us today. We hope this deep dive has provided valuable perspective and empowered you with a clearer understanding of the housing market. May you have a blessed and financially informed day. Don't let housing costs remain a mystery. Subscribe to our channel for more in-depth analyses that empower your personal finance decisions. Share this video with anyone grappling with rising housing expenses to help them understand these critical dynamics. Leave a comment below with your questions or experiences. Your input fuels our community and helps us tackle the most relevant topics. Visit our website for additional resources and tools to navigate the complex world of housing and personal finance. Take control of your financial narrative today.